Hey, good morning, everyone. Chris Lopez here, and I'm excited to host this webinar today on understanding the taxes and K1s when it comes to real estate syndications, real estate funds, real estate partnerships. This is always a hot topic and also a complicated topic that we have our investors and a lot of prospective investors want to learn about. So we'll kick it off here in about 2 minutes as we allow people rolling in. I am joined by Matt Amundsen. Good morning, Matt.
Good morning.
All right. And I always like, I know we already got quite a few people in here. Can someone type in the chat box? I'll make sure it's working. And also keep this webinar interactive. If you guys can post what city or what state you're in, I always like to know the geographic location. We're usually mostly Denver, Colorado, but we got lots of people. So if you guys can type into the chat box, it helps me make sure that I've also got the chat box working so we can keep it engaged throughout the way. So, our first one, Oakland, California. Awesome. All right, a lot of people can hear us. Denver, Springs. Yep. A lot of the Colorado crew. Awesome. All right, well, looks like we got most of the people in the webinar here, so we will officially kick it off. All right, good morning again, everyone. My name is Chris Lopez, and you are here to learn about the taxes and K1s when it comes to real estate syndications and funds. I'm joined by Matt Amundsen. Good morning again, Matt.
Hey, morning still.
And so this is a really common question we get from people, especially as a lot of people are shifting from only having active rentals and they start getting the world of passive investments. While there's a lot of similarities, there are also some distinct differences, especially when it comes to how your earnings, how depreciation, how it's reported, and the timing of it. So I'm really excited to have our guest here, Thomas with Hall CPA. So we got connected with them quite a few months ago. But after many years of trying to find CPAs that A, knew real estate investing, and B, could actually take on new clients, met Hall CPA, and I was like, oh my goodness, we're become best friends. So over the last couple of months, I've gotten to know Thomas, gotten to the Hall CPA platform, both their CPA platform, and they have some educational platform as well. And I'm thrilled to have you on here, Thomas. Good morning.
Oh, good morning. I was on mute. Good
Yes.
morning. Thank you for having me. It's an honor to be here today and excited to talk about K1s and tax issues for syndicates and funds.
Yeah, so please dive into it. I know you have a detailed oriented PowerPoint, and it's going to be the first of a few webinars we do. So if you guys have any questions along the way, please post it in the chat or the Q&A box, and we'll have Thomas answer along the way. But Thomas, tell us about the K1s, man.
Yeah, absolutely. So today we'll be going through real estate syndicates and funds and related tax issues, including K1s. So more specifically, we'll be diving into annual tax filings required for syndicates and funds, which are taxed generally as partnerships. Then we're going to be going through some of the tax documents you'll receive as a limited partner. This includes Form K1. We'll also take a brief look into a Form K1 and kind of step through that briefly, or at least the key elements of it. And then from there, we'll talk about the tax differences between distributions and allocations, there's a lot of common misconceptions in this space, and it's not surprising. This stuff is complicated. And then later on, we'll touch briefly on some additional things regarding state K1s. So we'll go ahead and dive into all of that. So first things first, annual tax filings, Form 1065. This is the tax return that the partnership is going to file. It's going to be the syndicate or fund. So it's required by all partnerships, and it reports the income, deductions, gains, losses, and all of the other information required for partnerships on Form 1065. It's important to note that when it comes to partnership tax returns, these are typically known as informational tax returns, because at the end of the day, the partnership typically does not pay taxes on behalf of the partners. Instead, it passes through that information to the partners via Form K1, which we'll be going through. And then you, as the limited partner, you'll take your Form K1 and you'll report that on your Form 1040, and you'll pay taxes according to your individual tax situation. So Form 1065 is typically going to be filed by March 15th or September 15th if extended. And I'll probably say this a few times throughout the presentation, but typically it's not uncommon. In fact, it's very common for syndicates and funds to extend their tax return beyond the March 15th deadline, simply because this stuff is complicated. There's usually a lot of investors, and to get all that information done and get it done accurately the first time, which is the best way to do it, it typically requires an extension. Now, I've been a limited partner in various deals for the last 8 or 9 years myself, and I've been extending my tax return, my individual tax return, for that amount of time. And it's just part of the game. And I know a lot of limited partners who are new to investing in this way are sometimes surprised to see that. But I just want to kind of say that this is just part of this game. All right.
I
So
love it. And actually, I got a question here for because I've been as both when I've been an LP or GP on either side. I've never had any of those investments filed by March 15th. It's
right.
always been extended for the reasons you said. Plus, a lot of times cost sig studies. I'm curious for you as an LP, have any of your investments ever actually filed by March 15th?
I have had a few investments where the partnerships were, or the syndicates and fund of the GPs, general partners, sponsors, they were adamant about getting it out on time. So there has been a few. However, that's never allowed me to file on time because there was other syndicates and funds that didn't get it on time. So I still had to wait. And hopefully I'm helping some of the sponsors out there because we get this all the time. LPs are like, where's my K1? And a lot of times if you're coming from the stock world, right, the world of brokerage accounts where you receive your 1099B, you can upload it to TurboTax like that. It's not quite the same when you transition into the world of passive investing. So perfectly normal to extend, and I would expect it to be extended if I'm investing as an LP. Now, one more thing on Form 1065 itself. It's not provided, the actual full Form 1065 is typically not provided to the limited partners. The managing member would have access to that, and that's because it contains the information of all partners, a lot of sensitive information they're not going to share with everybody. So this is something to know. You'll receive your Form K1. Now, within Form 1065, the actual real estate itself, the rental real estate, is typically filed on Form 8825, which is basically the partnership version of Schedule E, if you're familiar with that form. And then again, you will receive your K1 along with the rest of the partners. So Form 8820, sorry.
Sorry, if you go back to that slide to clarify something, because this was something that I got a little confused on when I was first getting onto here. So we got Form 8825, Form 1065, Form K1. The LP, just clarify, has nothing to do but wait until they receive their K1, right?
Exactly.
Yeah.
Exactly. We just had some questions in the past of like, how does this work for the partnership? And the partnership is going to report the properties on Form 8825. That gets rolled up into the Form 1065. Then it will shoot out Schedule K1s for each of the individual partners. So
great. Thank you.
No problem. Now we have Form 8825's rental real estate income of a partnership. Again, this is where the rental property is actually provided. You as a limited partner do not need to know much about this. Again, I'm just including this in here so you have this little bit of information on how this works for the partnership. So the partnership's going to take their P&Ls, their information on the properties, and their tax preparer is going to put it on Form 8825, and that's ultimately going to help generate the K1 that you'll receive. Now we're going to get into the fun stuff. Schedule K1, the partner's share of income deductions and credits. Again, Form 1065 is not, the partnership itself generally does not file taxes. So when you receive your K1, we'll go through an example in a second. You're going to receive on your K1, you're going to have your share partner's income deductions and other items related to the partnership. And this will go on your Form 1040. So this also includes a reconciliation of your capital account, showing the beginning and ending balances. And we'll talk more about that. Then it includes any contributions or distributions occurring throughout the year. So if you put money into the partnership, typically done during the first year, or perhaps if there's a capital call, and then there will be the distributions, which is money that you might be receiving from the partnership. And that's pretty much how it works. And from the K1 perspective. So what I did was I do have a sample K1 here. This is from 2022. However, they don't change all that much year over year. So if you have one
Can
for
you zoom in on that, Thomas?
Yep, absolutely. So here it is. So briefly, I'll go through some of the stuff on the left. The left is more informational than anything for the most part. So here would be the partnership's EIN. This is obviously a fake EIN. The partnership's address. So whatever the address of the sponsor, wherever they have the syndicate or fund held. Then it'll be your SSN or your EIN if you're investing through an LLC. You'll then have the name of your name and your address. And then down box G, it's going to let you know whether you're a general or a limited partner. For the most part, limited partners are going to check this box over here, or it's going to be checked on your behalf by the partnership. And then it's going to have whether or not you're domestic or foreign partner. If you're in the US and you're a US-based taxpayer, it will be checked domestic. And then if you are investing through an LLC, it will have some information here about that specific LLC. Moving right along will be your share of losses, so your partnership interest. This generally does not change all too much. And this will be your share of partnership liabilities, so your share of any of the loans that are allocated to you based typically on your ownership interest, although that can vary depending on how the partnership decides to distribute that. Now, we're getting down to box L. This is your capital count. So this is actually an important area to keep aware of. So your beginning and capital count is typically going to be 0 for the first year. And then in that first year, you're typically going to make a contribution. So in this example, we assumed that the taxpayer contributed $75,000 to the syndicate or fund, not an uncommon number to see. Then here you'll see any income or losses. I'll talk about that on part 2 of this in a second. And then any withdrawals or distributions throughout the year. So this is money you took out of the partnership. And then it will be your ending capital account balance. Now, your capital account is increased by contributions and income or gains, and it's decreased by losses, and it's also decreased by withdrawals. Now, this is just something you want to be mindful of. You're typically not going to have any issues here, but if your capital account does go negative, which is rare, and you do take distributions, like say, for example, this was 64,000, this was 0. Say this was 0 or negative, you would then be taxed on distributions from the partnership. But again, that is rare. Just wanted to cover this because we do get some questions on that from time to time, how that works.
I have a question. If you can go back to that L box. So for the capital contribution during the year, you got 75,000 listed on there. So did I hear you correctly saying, hey, that is my initial investment. So I invested $75,000 into this deal. But then if that property distributes $1,000 in rental cash flow that year, that'd be added to my capital account as well.
So if it distributes it, it's going to decrease your capital account. So distribution, you take money out, it decreases your capital account, but income itself could increase. It generally increases your capital account.
So, okay, if I get income from the property, that will increase it as well. Then if it's distributed, it'll be knocked down or taken out a few lines below.
Right. Exactly.
Cool.
Exactly. And that kind of brings us up to part 3 here. So typically in box 1, this is ordinary business income. You generally don't see too much of this, if any at all, on most real estate partnerships because they're not generating business income. You might, if the partnership is involved in any other business activities, but it's more uncommon. Then you'll see box 2. This is the net rental income or loss for the year. So this will typically be negative in the first year, or perhaps even the first few years, depending on how the partnership operates. However, if this box is positive, if for some reason it's positive, this means that this will be taxable to you, right? So if it's positive, it could be taxable. Now, as we kind of go down, these boxes 1, 3, 4, 4A and 4B and 4C are typically something you're not going to see as a limited partner. Because this would be stuff that would be on the general partnership's tax return if they do, the general partner, if they do take any guaranteed payments, which is basically a salary. And oftentimes that's not the case. Now, 5, interest income. You might have some interest income from cash on hand held by the partnerships in their CDs or their savings accounts, etc., checking accounts, whatnot. Box 6A, 6B, and 6C, you're typically not going to see in real estate partnerships. You might see those in like hedge funds or something along those lines. Royalties, again, you'll probably also not see that in a real estate partnership, but you might see it in an oil and gas partnership. Now, as you get down to 8, 9A and 9B, so 8 short-term rental gains, you typically not going to see that either. Most of the time, it's properties held for longer than a year. But if the property was to be sold in a shorter period of time, you may see something in box 8. Now we get down to box A, 9A. That's going to be the long-term capital gain upon sale. So you typically don't see anything like that in a syndicate until it's sold, but in a fund, you might have a life of a fund that's 10 years and properties may be sold in between. So you might end up seeing that depending on how that fund operates. Now, as we get down to 9C, box 9C, unrecaptured 1050 gain. This is depreciation recapture from straight line depreciation. So if you do have that there, that will be reported in box 9C. And then 10 will be section 1231 gain. This is long-term capital gains from the sale of real property. So you might see a number in there as well, depending on how everything shakes out. Box 14, self-employment earnings. You're typically not going to see that as a limited partner. Rental income is not subject to self-employment taxes. So that will usually be blank. Credits, that's also uncommon, but it depends on the type of partnership you're investing in. You might see that. Box 19, distributions. This is where you'll see money that is distributed to you. And we'll talk a little bit more about this in a minute or two, but I want to just kind of clarify these two boxes, box 2 and box 19. All right. So you can have positive rental income in box 2 that is taxable, and you might not receive any distributions, right? So distributions typically are not taxable. So you can have a loss and receive a distribution. So the partnership gave you cash, distributed cash to you, and not get taxed on the distribution, right? But similarly, you can not receive a distribution, have 0 in box 19 and have a positive number in box 2, and then that will be taxable to you. So distributions are typically not taxable, but income on box 2 is, and that's a key distinction here. I know we get a lot of questions on that specifically. So box 2 is what's going to be taxable or not, depending on if it's positive or negative. And box 19 is typically not taxable. Now, box 20, there's just a lot of various information about the partnership that could be down here. I'm not going to spend too much time on it, but it could be the business income deduction, QBI deduction, perhaps is sometimes reported there, 1099A. And there could be a whole hodgepodge of things that are just information that is attached to the partnership. So, but the key points, just to summarize, is going to be box 2. These boxes down here with the capital gains, and then line 19, your distributions are typically the most important of these forms next to your capital account.
Yeah, Thomas, can we get some clarification on where investors would see like depreciation losses?
Right. Great question. So box 2. So what happens is you're going to have on the form 8825 that actually reports the tax return, that actually reports the property. It's going to have the income. It's going to have all the operating expenses, property management fees, repairs, maintenance, all that good stuff, property taxes. And then on that, there's going to be a line item for depreciation. And then at the bottom of that 8825, there's going to be the net income or loss for the year. And based on the partnership's allocations of that, that's going to show up to you in box 2. So ultimately, box 2 is going to show income or loss, and that's going to include the loss from depreciation, which is why it's quite common to see, especially in year 1, if you're using bonus depreciation, very common to see box 2 to be quite large in the first year. And if there's a value add play or the BRRRR strategy, for example, and there's a lot of intensive work going on at the property and they're not leasing it up very quickly, which could be the strategy for that particular investment, you might also see box 2 negative into subsequent years. So that's box 2 is ultimately where you'll see your depreciation.
And then box 19 there, those distributions, you say that's not taxable. Is that because that's generally a principal return?
So in short, yes, the short answer to that question. Basically what happens is when you have your capital account, as long as you're positive, see this is ending capital account here, 64,900. This means you could theoretically withdraw $64,900 from the partnership and it's not taxable. So the distribution is typically not going to be taxable unless this account is 0 and you take a distribution in excess of your ending capital account balance, which is, it happens, but it's I would say it's quite uncommon. It's not something you see often for most people. And that's because typically there will be usually when there's a large distribution that would be in excess of your capital accounts, usually at the end of the investment. And then what would happen is in box 10, between box 10 and 9A, you're going to have a gain that's going to be taxable. And that's going to increase your capital account here in the current year, net income or loss. So I guess in a roundabout way, what I'm trying to say is when you contribute the $75,000 to the partnership, you're going to have a basis of 75,000. The income or loss will increase your capital account if it's taxable income, or decrease it if it's a loss. And then the distributions will also decrease your capital count. Now, if you take distributions in excess of your capital count balance, that's when you get into the taxable situations. But for the most part, that's a non-issue. And not getting too much into the weeds, the reason why it's usually a non-issue is not only are you normally not taking distributions in excess of the amount you put in for the most part, but also for real estate, there's something called qualified non-recourse debt, QNR. And qualified non-recourse debt is simply debt, for long story short, debt that's secured by real estate. And QNR actually increases your basis. So if you are allocated, parts of the debt, which is common in these partnerships, that can also increase your capital account as well. Again, shielding your distributions from tax. So, you know, I know I've mentioned it a few times, but it's rather uncommon to see that. And if you do see that, something you're going to want to check with your CPA first, right? Just to see what's going on. They could probably guide you in terms of what's going on. And then if there's still discrepancies, you could always go to the sponsor and speak to their CPA and say, okay, why is my account balance negative? Here's kind of where the situation is. But it's not something that's common.
Great. This is fantastic.
All right. Is there any other questions on this specifically before?
Yeah, if anyone out there watching, if you guys have questions, try type it in now before we move on to the next section, because those questions were really from me and Matt here. We were curious, but I think we're good on questions, so let's keep rolling.
All right. And those are good questions. Now, annual tax filings, we covered this a little bit, but Form 1065 again is due March 15th or September 15th if it's filed an extension. The general advice here is, again, like we mentioned before, you will probably, if you're investing in syndicates and funds, if you're investing in enough of them over a longer period of time, you're inevitably going to have to file an extension. So typically you want to assume this is going to be the case. You want to go ahead and proactively do that. Your CPA can do that on your behalf, or you can do it relatively easily yourself. So when are your personal tax returns due, right? So ultimately your K1 gets reported on your personal tax returns. Well, the personal tax returns are due on April 15th each year, or on on October 15th if you do file an extension. And again, there's nothing wrong with filing an extension. The one thing I do want to say here is that April 15th gives you an extension to file your tax return, not necessarily an extension to pay. So if you do end up owing money, you will have to pay by April 15th, or you'll start accruing penalties and interest for not making a payment. Now, a lot of times syndicates and funds will send out tax estimates to their limited partners, letting them know here's the estimated tax impact. And then you can go to your CPA, your tax preparer, and let them know, hey, here's the estimated income, losses, deductions, et cetera, from my partnership. They can put it into a projection software and give you a projection. Now, this is typically important if you are, say, a self-employed individual. So you might be paying your own taxes and have your own quarterly tax estimates. And if you expect to have positive income or a gain on sale from the partnership. So in other words, if you're expecting income and not a tax loss, this is something you may want to have a conversation with your CPA or tax preparer about. But it's typically a relatively straightforward process. I just realized there's a typo here. So that's kind of a little bit about your individual tax returns and how that plays in. Now we kind of already
Actually, before we want to say that, I want to highlight, because a lot of times, yeah, the estimated K1s, like majority of deals I've invested in, I get those. The ones I've, usually GP'd, we give those out as well. But understand, those usually come out usually between about April 1st and April 14th in my experience. So they come close down to that April 15th timeline window. So, have kind of like my recommendation when I've done as an investor, have like your high level stuff figured out. Have like the big picture figured out with your CPA if you're, about on track, or you might owe some or get some back. So when you get these numbers at the last minute, you can quickly add those to a spreadsheet and make any adjustments or payments that you may need to do. And I'm in the process right now doing this. And for some of our deals last year, we're starting to get ours organized, and we'll have ours out soon here before April 15th.
Yeah, and Thomas, I got a follow-up question on that. The penalties and interest, say you make your estimated payment and then there's a significant difference or a difference at all when you actually file in the October deadline, will you be subject to any penalties or interest?
Yes. So if you have an underpayment, say you owe say on April 15th, it comes and goes, you make your estimated payments. And then by the time you actually file your tax return, so let's just say, for example, it's in July, right? You receive all your information, you file your tax return in July. If you owe the IRS and perhaps the state authorities money at that point in time that you've not covered in your estimated payments, so if you have a balance due, that's typically what it's called in your tax return, that balance due is subject to penalties and interest. The rates kind of vary. I don't have the exact rates off the top of my head, but will say though, that as interest rates rise, or as they have risen, so have the interest rate that the IRS will assess on you. And I think it's around 8% the last time I checked. And so this is critical to dial this in. For most real estate partnerships, though, the good news is most of the time, at least in my experience, you're receiving negative K1s in the initial years. Those negative K1s give you passive losses. So first of all, when you have a negative K1, doesn't mean you're necessarily losing money. It's typically from depreciation, which is that non-cash expense, or doesn't mean the syndicate's losing money. But you're gonna have that negative K1 and you're not gonna have a balance due from the partnership. So whether or not you have the estimate or not, usually isn't so critical in the initial years. And on top of that, once you have this negative balance, this passive loss, it's called, then that will get carried forward. That could be used to offset other passive income on your tax return if you have any from that specific year. If not, it's carried forward to future years where it will then offset income and gains from the sale of properties in future years. So long story short, I'd say more often than not, at least in my experience, you're not going to see too much tax issues coming from this in the initial years of the investment. The biggest year to pay attention to this and that estimate would be in the year that the syndicate sells the property, or if the fund sells a property, because that's when you're going to have a significant tax event. Usually the gain on sale will be significant, hopefully. And then you have to do some tax planning around that.
Okay, because I would say, like myself, and I think a lot of our investors are looking to offset some passive gains with our passive losses. So is that more significant for us than making our estimations and paying our taxes in the current tax year?
I would say managing that is high priority. And as a limited partner or as a passive investor, the name of the game is you want to basically generate passive income and then use passive losses from other investments or the same investment in some cases to offset that income. So what ends up happening is, to give some examples, initially for most partnerships, if they're using a value add strategy, there's typically not going to be much taxable income during the life of the investment. Most of that money is getting plowed back into the investment. And if you do have taxable income, it could be minor, but if it's going to be significant, then you want to make sure you have passive losses to offset that. So if you're like in a more of a cash flow type of deal, or you're going to be receiving a lot of cash flow, you might have income that's positive in that box 2. You might have positive income in box 2 here. And in that case, you want to just be mindful of that and make sure you have passive losses to offset that. Now, the good news is, to get passive losses, there's a few ways you can get passive losses. You can get passive losses by investing in another syndicate or fund in the same year. So if you expect to have positive rental income from another syndicate, go make another syndicate or fund investment, assuming it makes sense to do from an investment perspective, and you can get those losses. Where this really comes into play is the lazy 1031 exchange. I know we talked about that on your show. The lazy 1031 exchange is when you have a sale of property, and say 2024, you have a sale of a property, and you're going to have a big capital gain. You go invest in another syndicate or fund that's going to use cost segregation, going to generate these non-cash losses, and you can use that loss from this new syndicate or fund to offset the capital gain from the syndicate or fund that just sold. And this, you could also generate passive losses from going investing in property directly. So you can go buy a duplex, for example, and you could run a cost segregation study, which increases the depreciation expense, long story short, use those losses to offset the gain on sale of the syndicate or fund. So it's another way.
Hey, Thomas, we got a question from Roger. He asked, are there any limits on the passive loss carry forward?
Yeah, that's a great question. There are none. The passive loss carry forward will be, you can have an unlimited amount of passive carry forward. So there's no limit on the amount you can have, and they will carry forward indefinitely. So there's no time limit on which to use those either. So it's a great tool. It's a great tool. You could track your passive losses to see how much you have on form 8825, or excuse me, 52, I'm sorry, of your tax returns called the passive activity loss rules. And on that form, it'll tell you how much. So if you go back and look at, say, your 2022 tax return, or perhaps your 2023 return, if you have it, it will tell you how much passive losses you currently have available. So the first thing you should do is, if you expect passive income, or if you're going to sell a property at a gain, go look at that form 8852, I'm sorry, from the prior year, and go see, do you have passive losses? And if you do have substantial amounts of passive losses, you may not have to do anything, or you may have to do very little, right? But if you have none, that's a planning opportunity for you to say, hey, should I go invest in another syndicate or fund this year? Should I go invest in a rental property this year? Wherever the case may be, to generate these losses to offset your gains. So that's kind of the main game, the tax strategy for limited partners. It's just making sure you have enough passive loss to offset income and gains.
We got a few comments in here of people saying this is the best info they've seen on the subject. So great job so far, Thomas, and the audience is enjoying it.
Well, I appreciate that, and I appreciate that, everybody. If anybody's have any questions on this, please do drop them. But if not, we're gonna move on from this slide. And we'll talk a little bit about tax allocation distributions. We already talked about this a little bit. But again, taxable income, so the income that you'll pay tax on, is generated by the partnership's earnings, less their expenses, and then allocated to the partners based on the operating agreement, which is typically pro rata, but there could be some nuances there depending on how the partnership set it up. So you always want to make sure you refer to your operating agreement to know how much you'll be receiving and when you will be receiving it. Depreciation deductions are included in the calculation of taxable income. So again, that box 2 will include your depreciation, and that will usually result in a negative number in the initial years. Distributions are generally made from cash flow that the partnership is going to distribute, and you may or may not be receiving distributions depending on the investment strategy of the partnership you invested in. Are distributions taxable? Generally, they are not taxable under IRC, so the Internal Revenue Code section 731. Distributions are tax-free to the extent you have basis in the partnership. So that's where that capital count in box L we talked about. You want to make sure, as long as that's positive, you won't be taxed on distributions. And it is uncommon, again, to see those distributions being taxed. So it's kind of what it just says here. And state K1. So this is the interesting. So most of what we covered here today was the federal K1, which is where the bulk of what you need to know is from. And the federal K1 generally will translate and trickle down to the state K1. So state K1s take information from the federal K1 for their states. Now, when it comes to states, before I kind of go all into this, there's always debate: should I file a state K1, right? Because you get your K1 back, and if you're investing in a partnership that has, let's say, if you're investing in a partnership that has multiple properties across multiple states, you might have 5 state K1s, for example. Now the question is, like, if there's a loss and the state K1 has a loss, do you need to file the state K1? Typically, you do not. Typically, depending on the state, most states work like this. You do not need to actually file the K1 if you have a tax loss. The states, they don't care that you're losing money, right? They only care when you're making money and you have to pay them. However, for the most part, you do want to consider filing that state K1 anyway, especially if you have a big loss. Because if you have a big loss from that property, you want that to carry forward on the state K1 to offset the gain on sale or perhaps passive income you're generating in the future. So it's just something to be aware of. In general, you do want to file the state K1s, but depending on the cost and the complexity of your tax return, you may or may not file them based on your preferences and whether or not you have income. So state-sourced income, although you may receive multiple state K1s, generally only K1s with state-sourced income are applicable, meaning, so for example, if you have a property in Georgia, and we'll go through an example, you'll typically have to file a state K1. Now, on these state K1s, states typically have different rules than the federal government. They're similar, but they make adjustments based on however that state wants to operate, pretty much. So state add-backs, Sometimes there are add backs for bonus depreciation. So you might get that bonus depreciation deduction at the federal level, but you may have to add it back on the state return. And that's a common adjustment you'll see on the states. Then state subtractions. There could be different things that are subtracted from the state return that are not subtracted from the federal return. So in other words, you might have to add expenses back that increase the amount of tax you would pay on the state return versus the federal return, or you might have things that actually decrease depending on the nuances of that specific state. So here's a quick example of one. So this is a New York K1. If you're not a resident of NY and the partnership does not own property or operate in New York, you typically do not need to file the K1 in New York, right? You might receive the New York State K1 because the partnership had to file for other people in New York. New York's a very interesting state, so are states of California, but you may receive a K1 but may not need to file it. Conversely, if you are a resident of New York and the partnership does not own property, you may have to. If they do not own property, you still may have to file because now you're a resident of New York, right? So if you're a state resident, usually the state you're a resident of, whether it's New York, California, Denver, Colorado, whatever the case is, you usually have to file K1 in that state, usually because that's your state of residency. But that's something to keep in mind there. And Georgia, we'll go through a quick one for Georgia. The partner is not a resident, so you do not live in Georgia, in the state of Georgia. There's a typo here. But if the partnership does own real estate in Georgia, you may have to actually file a K1 in Georgia. So, and the reason, again, you may want to file this is to lock in that loss. As you can see here in this specific K1, this taxpayer has a loss of $184,000, likely through a very large capital contribution to the partnership and then a very large depreciation expense. But you would want to go ahead and file in this case to lock in that loss. So that's just some things about state. That kind of brings us to the end of the presentation. I do see there's a question in here. We get the slides. I don't know, Chris, if you're planning to send out the slides, but I could send out the slides.
It's your call. They're your slide deck. So if you're happy to share them, we'll definitely pass them along.
Okay.
I want to be respectful to your slide deck, though.
Yeah, no, I'm more than happy to see. You can send it out. It's all good.
Cool. We will send out the recording and the slide deck probably a day or two after the live event. So yes, we'll send that to you.
Okay.
And we've got a very detailed question too. I'll let you tackle that one, Thomas.
Okay. Very little information exists on how to translate the K1 box amounts to calculate final adjusted cost basis. How can one know to calculate the final adjusted basis correctly so that the gain or loss on 19A? So I think if I'm understanding this question correctly, you're asking the adjusted cost basis of the property. So that would be held by the partnership. The Form 1065 would have that, and they would be passing down your information to you via the K1. So if you're interested to make sure that's verified correctly, you would typically, again, if I'm understanding the question correctly, you would have to request the detail information from either the sponsor or their CPA, who could provide you that detail. And depending on the sponsor, they may or may not provide you that detail. Most probably will, I guess, I would assume, but that's how you would figure that out. Otherwise, you're just getting past the information that's attributable to you directly. I think that would cover that one. There's another one in here. Okay, it says about the recording. Okay.
Yeah, we got quite a few about the recording in there. Yeah, recording and slide deck we'll send out tomorrow or the day after.
All right. So that's pretty much the presentation. Happy to continue taking questions. If you do want more information on this stuff, I do have some resources available. So Chris will send out, I think Chris did say he'll send out the slides, but we do have a tax strategy foundation course for limited partners. And this is actually part of the course. It's actually one of the mods. I adapted it, of course, for this presentation, but the course covers everything you need to know from a tax perspective for a limited partner. You could sign up for that at www.taxsmartinvestors.com/limited partners. And you can use the code Q1, so Q1 like quarter one, for 50% off. And I think Chris will have a link for that as well for everybody after the show. And then lastly, if you are looking for a new CPA, you can request a consultation at therealestatecpa.com/Thomas, and we'd be happy to learn more. And lastly, we do have a podcast where we do go through a lot of this stuff, the Tax Smart REI podcast. It's on Apple and Spotify. And I know Chris will be joining us in a few weeks. And it'll be an awesome episode. So that's pretty much it for this presentation here.
No, this is great. And this is, one of the tips of the iceberg when it comes to understanding taxes, to real estate in general and partnerships and syndications. So we have a few more webinars lined up too that we're doing with Thomas and Hall CPA on various topics. So rather than trying to cram everything into one webinar, we have spliced them into kind of a different topic. So we'll have Thomas back on in the future for some other webinars. So Thomas, this was great. Excited to have you back for future ones. And then we got a question here. Some people interested in maybe some CPA services. A person asked, I have a longtime CPA. How do you integrate your analysis and work with her?
Yeah, so that's a great question, and it depends. It depends. In most cases, when clients come to work with us, they end up transitioning away from their longtime CPA. Although there have been cases where we have worked, collaboratively, and it depends on what capacity you work with us on. In most cases where people retain their existing CPA, it's for tax preparation, or perhaps you have other businesses that you've been working on with them for years that you're not going to move everything, and that's cool. We typically work on the advisory side. So if you come on board for tax planning, we're going to give you a tax plan tailored to your situation, where you are today, where you're looking to go, how you can minimize taxes, what moves to make, what moves to avoid making, perhaps in some cases. And then you receive a blueprint, which is a written tax plan that includes a summary of each of the strategies and how it applies to you. And you could hand that to your CPA, and they can work from that. That's typically how we've seen it go. There has been times we have consulted with other CPAs in circumstances like that. So to answer your question, Roger, it somewhat depends, but usually there is information crossover between the two CPAs.
And if I said at the beginning of the webinar, I got connected with Thomas and Hall CPA a few months back, and we've had some conversations, and I really liked obviously their subject matter expertise in the world of real estate, which kind of checks off the first box. But the second big box is they are scaling their business, or I should say they have scaled. And this has been one of my frustrations for a lot of CPAs we've recommended over the years, even my own personal CPA. I have a great CPA here in Denver. His office is off of Hamden Avenue. But 4 years ago, he stopped taking on new clients. And, it's very common where, hey, one of our team members or a client will have a great real estate friendly CPA. And then within 2 weeks of recommending that CPA is no longer taking on new clients. And so I was really excited to hear Thomas explain kind of how they've grown the business, and they're able to scale the business so they can continue to take on new clients, which for me as a referral source is a blessing. So thank you, Thomas. I'm really excited about that.
Thank you.
Who is kind of the right type of client avatar for you? Is it like a brand new real estate investor, someone just with syndication, someone with rental properties? Kind of what's the right avatar, generally speaking, that's a good fit for Hall CPA?
Yeah, that's a great question. So we work with really real estate investors across the map. I think the biggest thing, we have clients with as little as one rental property all the way up to syndicates and funds who are operating funds. So we've seen it all. And really, I think the key, the floor, I guess you could say, if that's the right way to say it, would be typically you have ownership of property already. What we found is that we can add a lot of value if you own property, whether it's through a syndicate or fund, or whether you own it directly. Once you own it property, before that point, there's just not that much that we can do to assist in that aspect of it. And usually most of the planning strategies really only become relevant once you have a property. So if you have a property under contract and you're close to closing, that might be the time to start that conversation. But if you're just thinking about jumping into the game at this point, you might be better served with resources like this for now. And then once the property acquisition is more imminent, I guess you could say, or more, more certain that's going to happen, that's when you want to start that conversation. So to answer your question, pretty much if you have rental properties at that point in time. And, at any given point in time, there's usually some way we can add value to your situation.
Great. I'm going to start rapid firing you some questions here, Thomas, if you're cool with that.
Cool.
This is a personal question for me, and hopefully you have a crystal ball. So I think it was the end of January, the House passed that bill, includes some child tax credit, and they're going to expand and kind of bring back the 100% bonus depreciation. What does your crystal ball tell us about that getting passed this year?
Yeah, so we've been keeping an eye on that very closely. We have members of our firm who have, I don't want to say inside information per se, but they know people. And the bill originally came in to 2023, at the end of 2023, moving into 2024 with a lot of momentum behind it, bipartisan support, presidential support. It passed the House. Then it went to the Senate. And at the Senate level right now, basically, there's a lot of opposition of it getting passed in the Senate. And that has been being debated over the last few weeks. And at this point, I mean, I hate to say it, it does not look good. I will say that it does not look good to pass. There's a lot of rumors on why that is. We are in an election year, and some people believe that they're stalling for having something passed and waiting till after the election. That's speculation. I don't know. But long story short of it, right now, unfortunately, from what I'm seeing, and I could be wrong, but it does not look good. That's what I can say. It does not look favorable. It does not look like it. Unfortunately, it doesn't look like it's going to get passed.
Don't worry. We won't kill the messenger. Here's another question here from Matt. He's actually asking, how are you able to scale your CPA business to take on clients? Because as you probably know, this is one of the biggest frustrations we've had as investors here. So how are you guys able to keep up with demand for new clients?
I think we're, in a weird way, and I'm a little, I don't know how, but we're like a unique animal somehow. What we've scaled our leadership team. So we basically did is we have different parts of our leadership team working on various aspects of the business. And that includes, say, for example, marketing, or then talent acquisition is important. So we have a VP of talent, and her role is to make sure we can staff the teams. And that's the biggest part of a service business, especially in a CPA firm, is at the end of the day, you could generate as much business as you want, but someone ultimately needs to handle, to fulfill the services. So I think the fact that we're remote, we're 100% remote firm, we can hire across the United States. We're able to attract talent that wants to be remote, that loves real estate. And then we have an excellent training program that we put them through. And that gets them from, wherever they're at to real estate expert. Most of them already have real estate experience when they come work with us come join the firm, but we put them through a training program that makes them experts. Basically that's how we're able to do it. It's a combination of talent acquisition and just having those systems in place to be able to hire, and also training programs. Now, I will say that there's a lot of chatter around the Big Four, that there's a drought in the accounting pipeline, and there is. There's not enough accountants coming into the industry. They're opting for other jobs, tech jobs, jobs that are more, lucrative coming out of college and don't require as much work. However, the pool of experienced talent, so existing talent, is still very much full. And because we're a unique firm, because we have a niche in real estate, because we're remote, we can attract those talents. We can get them to say, hey, I want to work for you guys over whoever they're working for. That's what keeps us unique, and keeps us being able to staff the teams, is that we're able to hire across the country, and we have a unique offer for those accountants.
I love it. All right, going back to some tax questions here. Joe says, or asks, can you give more information on how you are taxed in regards to the final K1 at the end of the partnership? So I assume it means, hey, take your typical multifamily value add project, year one, lots of depreciation, years 2, 3, 4, some cash flow, and year 5, the sale and the big disposition. Yeah,
no problem. So here is the K1. So typically in the final year, you'll have positive numbers in box 9A, between box 9A and box 10. That's the income, that's the gains that you'll be taxed on. So that's typically what it looks like. The biggest things you'll see in on your tax return in the final year. You also see distributions typically pretty high in the final year too, because you're getting distributed out whatever cash was eligible for you. And then the capital account will be balanced out and closed on that final year. So you'll have, your distributions that are getting taken out. This will all kind of zero out and at the end of the year. So I don't have a specific example of that available right now. But again, just to kind of summarize, usually in the last year, what you're going to see is gain in these capital gains boxes. And then you will see this partner capital account get zeroed out. And it will be kind of all kind of line up at the end. And then you'll usually have distributions in box 19 as well. So that's really the main thing. And then, sorry.
Oh, no, I'm sorry. Go ahead. I'm sorry.
And the last thing is usually this will be, there's a final K1. This box will be checked for you as well. Just notifying you that this is the last K1 that you'll be receiving for the partnership.
So, obviously when you get the final K1, it's, a big blessing, but usually a lot of times a big tax bill on there. And a lot of times, that their taxes capital gains. So that's a lower tax bracket, which is nice. But, one of the things that, Matt Ammons and I talk about and we do personally is, we do a lot of like, syndication ladder investing or passive fund laddering, because a lot of times people do that in terms of like, since this is lumpy cash flow, you have, big chunks of cash flow come at different parts. But we also talk about part of our strategy is that way we can hopefully have big chunks of depreciation every year as well to either like build up our depreciation bank for the loss carry forward, or as, hey, a property exits and we have a big capital gain bill, we hopefully have an investment with some big depreciation as well. I'm curious if you've got like a better strategy or advice on how to have like the best of both worlds of, hey, continuing to invest, but also how do you, always play the game of minimizing your tax bill?
Yeah. So, I think the way you described it is probably the optimal strategy for the most part. Really at the end of the day, the way I kind of look at it is the name of this game here is being aware of when you expect to have capital gains. It's going to usually be the biggest tax event for you in a partnership like this. And just kind of keeping your ear to the ground of when the partnership expects to sell and just making sure you're making investments leading up to that point to have enough passive losses. Now, I will say this, right now, bonus depreciation under current law is dropping 80%, dropping 20% each year. Right now in 2024, we're at 60%, which means in the first year that you'll have a significant depreciation expense in that first year. But next year, if you make that same investment, all things being equal, it will be less significant. And same thing in 2025 when it drops down to 20%. And so on. So 40%, and then 20%, 2026, so on and so forth. So strategically, from a tax perspective, now this year is as good as time as ever to make those investments, to start banking those passive losses because of the accelerated depreciation that you can get from 60% bonus depreciation. So that's from a tax perspective. But I tend to, when I advise clients, don't let the tax tail wag the dog. That's a big saying in our community, I guess you could say. And that's not making or overweighting the decision on taxes. Sometimes if you can't find a viable investment, and I'm not saying this is not the case, but if you can't find an investment that meets your criteria, meets your standards that you're comfortable with at the end of the day making, then sometimes it's better to pay the taxes. Because we've seen instances where people rush into an investment, especially around the end of the year when everybody's just like, I need to put my money somewhere. They run into an issue where they make a poor investment decision, and that investment maybe goes south. And now, sure, you might have gotten the losses from your partnership to offset your gain, but now you're actually experiencing real tangible losses of capital. And obviously, one of the Warren Buffett's rules, and who am I not to follow Warren Buffett, right? His rules are 1, never lose money; 2, never lose money. I'm pretty sure 3 is don't forget the rule number 1 and number 2.
Yep.
So it's that's the biggest thing is making a smart investment decision first and foremost, and really letting the tax benefits kind of be secondary to that. So that's kind of the way I filter through it. So I guess to answer your question, it's just being, again, aware of how much suspended passive losses you currently have. Again, 8552 of your tax return passive activity losses. And then when you expect to have income or gain from the partnership, and then making investments leading up to that point to shelter that income is with the bow on it that you want to make sure they're smart investment decisions for you.
Right.
Yeah, I got a follow-up question for you on now that we're in the 60% bonus depreciation in this current tax year. When does the rest of that depreciation come to us? Is that on like that more 27.5 year schedule?
Oh, yes, great question. So say 60%. So what's eligible for bonus depreciation is property has a class life of less than 20 years. So for real estate, that's typically 5, 7, and 15-year property, more so 5 and 15 than 7, but nonetheless. So the remaining amounts of that will be depreciated over 5, 7, and 15 years. So you'll still have a bit of accelerated depreciation on those types of assets. Depending on the property, anywhere between 20 to 30% of that property would be reallocated to those types of assets. So that will the remaining 40%, I guess you could say in 2024, would be depreciated over its normal depreciation schedule. Now, the remainder of the amount attributable to the building itself or the structure, that's 27.5 year property, that would continually be depreciated over 27.5 years. So you continue to get that. So in the first year, you tend to have a sizable depreciation expense. And then going forward, because you're kind of front loading a lot of that in a way. And then as you kind of go year after year after year after that, you still have a depreciation expense. It's just not going to be nearly as large in most cases as you were in the previous year. So you still get some of the depreciation benefit going forward at the end of the day.
Great. All right, I know we got about 4 minutes left, and I think we have 2 final questions on here. Do you guys handle taxes and advisory for self-directed IRA?
That's a good question. So we advise on self-directed IRAs. We could advise on that. And if you're a tax preparation client of ours, we'll typically be able to file your Form 990T, which is a form you may have to file if you have a self-directed IRA, because you might be exposed to UBIT, the unrelated business income tax. And long story short, that's generated when the partnership finances real estate with debt, as is the case in most syndicates and funds that I've at least been knowledge of. So we can help on that aspect of it. As for the administration of self-directed IRAs, that's not something we typically do. That's something we would either refer out to a self-directed IRA custodian.
Yep.
There's a lot of great ones out there. Or we would work with the company you're currently working with if you already have one. So in a nutshell, yes, we can help advise on it. We can help prepare some of the tax aspects of that type of investment, but we wouldn't ultimately facilitate the actual self-directed IRA itself.
Great. I think the last question here actually goes back to an earlier question on how you're scaling the business. And he asked, are you hiring CPAs or just accountants or a mixture of both?
Yeah, so that's a great question. We're predominantly hiring CPAs. If we do find an EA who is exceptionally talented or has really good real estate experience, we would consider hiring EAs. So an EA is an enrolled agent. They're basically, so the CPA is a comprehensive exam that covers financial auditing, business economics, taxes, and also financial statement reporting, which is mostly on the public accounting side, so for publicly traded companies, whereas an EA focuses just on tax. So the EA has pretty much, in effect, much in a way, the same tax expertise as a CPA has. And in those cases, because we predominantly work on tax at this point in accounting, an EA is an appropriate designation that we will consider for strong candidates.
All right. Well, I think we opened up a can of worms here with talking self-directed IRA. What, if any, services does Hall CPA provide in executing a Roth conversion strategy within their IRA? So, something some clients do, they have a traditional IRA, they rolled over, they invest in a syndication.
Right.
And since it's an illiquid investment, a lot of times you're able to get a fair market value to help, reduce the tax liability when they convert it over. What, if anything, do you guys help out with that?
Yeah, so that's actually something we're evaluating right now, that specific strategy, because I don't want to speak too early on this, too much about it, but there could be potential scrutiny for that. That may or may not be present. That's what we're evaluating. So I'm not saying there is. I'm not saying there's not. I'm saying right now we're evaluating it. And once we kind of move through those steps, we'll have a clear stance on it. But right now, I would say that as of this moment, it's not something we would typically suggest, but that could change upon further evaluation.
Awesome. Well, keep us in the loop as you do your due diligence on there, because we have a lot of investors, myself included, who are very interested. All right. Well, I know we are at the top of the hour. So first off, Thomas, thank you for coming on and delivering just a fantastic webinar, jam-packed of information. We got lots of great comments in here. And everyone out there, thank you for joining us and attending this webinar. We'll send out the recording, some of those links to the resources Thomas mentioned on here. And we have a couple other webinars scheduled yet. They're not on the calendar, but we will have additional deep dive topics into the world of real estate taxes. So if you guys have any specific questions or requests for information, please reach out to me and the team, because we'll make sure we get that on Thomas's calendar. And of course, Matt Amundsen, thank you for joining us.
Yeah, appreciate all the information you provided here today, Thomas. Thank you.
Anytime. Thanks for having me. It was a pleasure.
Thanks, everyone. Have a great day. Bye-bye.
Bye now.